Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Bill Bailey, analyst with Nasdaq IR Intelligence, for an update on the current state of technicals in the market. Bill, it's great to see you again. Welcome back to Trade Talks.
Thanks for having me back.
Let's start with market participation. Who was buying the rally?
Yeah, definitely. So I think last time we spoke, we talked in detail about retail's participation in 2020. So just to recap, they were a big factor into that rally. That kind of continued to the early part of 2021. They were a very strong participant. So last week was interesting because it was really our first week of seeing retail kind of push on the brakes a little bit and pause their buying. That's particularly interesting because we saw major indices, barge into fresh highs. So that kind of makes us think, like, if retail's not buying, who's doing the heavy lifting in the price action? And that ended up being institutional money. Institutional money was a big factor in pushing the stocks higher. Specifically, they were trading in the technology sector pretty strongly, software specifically. They're interestingly also an active participant in real estate, which I think kind of speaks to the broad participation that institutional was last week and their involvement in making markets go higher. I think that it's worth noting that for any rally to be sustainable or to have a shot at continuing, institutional money is usually a necessity for that aspect. So it's great to see retail participate, but them pausing just gave more participation room for the institutional flows, and they were really the big factor in last week's trading.
So, Bill, with that, what levels are you watching the S&P 500? I saw a couple strategists take up their target and EPS estimates for the index this week.
Yeah, I think a lot of people are getting, a little over ambitious. I think participation last week with breadth at 90% really gives, those analysts a lot of confidence to move those targets higher. I see that, and I also see the institutional flow that we were talking about as being very good for stocks. We're focusing. 3,900 is kind of hard to take your eyes off right now. I think 3,870, the market's pushed into that level last week or the week before, kind of fell back from that level. Right now, we're trying to see if the market can push above that, and we're going to have to see a few more days of, healthy volume and the stocks, pushing above 3,900 ultimately. Because right now we're in the midst of a breakout, and we really need to see this participation continue and volume to extend itself.
Tell us what's happening with prime brokers and degrossing. What does that mean, and why is it making headlines?
So I think it started with, all the frenzy a few weeks ago with, our buzz stocks that kind of were in the headlines and dominating the news wires for a little while. But really, when we think about retail buying and now passing the torch off to institutional money, you think of where's that supply coming from? And the evidence is supported by data, and it shows the prime brokers are supplying most of those shares. And what that means is that's where the hedge funds have a lot of the relationships at these banks. This can take a couple different forms of risk off. So there's selling from individual hedge funds. That's one factor that we're seeing. And then we're also seeing a lot of short covering, and there's data and evidence in the reduction of share lending activity that's going on, which correlates to short interest. So really, we're seeing a lot of risk off from the prime brokers and the hedge funds, and they're giving that supply directly to institutional money, who tends to be longer term holders, stronger, and they're willing to defend price levels a lot better.
And Bill, finally, what are you focusing on moving forward?
Really, it's this 3,900 level. It's kind of hard to take our eyes off that going forward, but I think traders are really interested in the equity markets as a whole. So they're focusing on areas and in ETFs where that might give them a cue that the market could be softening, and that tends to be defensive trades. Defensive trades is commonly the treasuries. Consumer staples is another area. Usually we see some strong bidding there as investors want to get a little more cautious. As of right now, the treasury ETF, TLT, has not really seen any strong bidding going on. So it kind of adds support to the idea that this rally has been very healthy. We would need to see some stronger price action in that market for traders to get a little more cautious. That has not happened yet. But really, the next few days are going to be pretty key to see how the S&P handles this 3,900 level.
All right, Bill, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.
Thank you.